One, as I mentioned in the announcement last week, I moved midterm 2 to this Wednesday, which you'll take during class time, unless you have an accommodation. So again, the midterm will open up 5 minutes before your regularly scheduled class. So right now we're in the 12:30 class, which means the midterm will be available from 12:25 until 2 p.m. Okay? But again, you have to take the midterm for the class that you're registered for. If you have an accommodation, there'll be a second exam link called the Alternative Midterm Exam. You'll have a password to take it, and then you can take it based on whatever accommodation you have by Thursday. The exam will be available on Wednesday. You have until Thursday to take it during whatever time that you have an accommodation for. Okay, so don't take the alternative exam if you don't have an accommodation. So make sure you take the exam that you're scheduled for. Don't click on it by mistake. All right. So the other thing is the exam itself, as I said, will be more qualitative, not quantitative. So as I said last week, basically you're not going to have to do a lot of calculation. It's just basically to understand what has been calculated, and we'll probably have a total of 6 or 7 questions, 3 of which you will know before the end of class today. Okay, so 2 of the questions I already told you what are going to be last week. So one of the questions is going to be, here's an ROIC tree, walk through it, analyze it, both levels, make sure you use numbers. Here's a CFI, walk through it, analyze it, use the approach that we've done in previous assignments. Start with free cash flow, talk about reinvestment rate, non-operating cash flow, debt, equity, cash flow, walk through. Those are 2 of the questions. Okay, and then there'll be one on multiples, which we're going to cover today, and then a few others, short answer, maybe multiple choice. Okay, that's the exam. It is open book. It is open notes. Obviously, you'll have to use a computer, but no collaboration, no searching prior exams, stuff like that. All that's really on a code bound. You don't have to physically be here, just have to take it during class time. All right, questions about midterm 2? It's worth 5 points. Okay, a couple things that came up in the last class. They just said, one, how long should the answers be? And the short version of that is long enough that you answer the questions. So, probably a few paragraphs, but most importantly, use numbers. Don't forget to use numbers, because if you don't put numbers in there, you're not going to get credit for these questions. So make sure you reference numbers in these answers. All right. And ultimately, as I said, you're not going to really have to do any calculations. So you're not going to have to do a conversion. You're not going to do evaluation. The data will be given to you. So today is more interpretive, the qualitative side, as opposed to the quantitative side, which was midterm 1. Okay. All right. So with that in mind, just a couple more reminders. This Friday, Group Case 3 is to be finished. So hopefully you have started working on that. Just terminology-wise, when you do Group Case 3, I did want to give you a couple of hints. So one of the hints is that you'll see in the worksheets, there's kind of 3 sections. At the bottom of every worksheet, there's a perpetuity. Don't forget to calculate that perpetuity value. Hate to lose points because you forgot to do something, right? And then secondly, you'll see a concept in there called salvage value. You have to calculate a return on salvage value. And so salvage value is basically another word for market value, current market value of the asset. Okay, so if I were to sell it to somebody else, what would the alternative cash flow I get for the asset be worth today? Okay, so it's current market value of the asset. So basically, you'll do 2 views on each of the steps. The first view would be kind of a return on the book value, the original value of the plant, and then the second will be a return on the salvage value, which is the current market value of the plant. And that will be important insights when you start thinking about the prices and the decisions that come out of that. So hint on Group Case 3. And then finally, we switched homework, was it 8 or 9? 9? Or the last homework assignment that you do from VF Corp to Costco, because it turned out VF Corp is doing a transition from a December 31st close to a March 31st close fiscal year this year. And so they put in a transition 3-month reporting period between their annual filings. So rather than having a 15-month reporting period to do the transition, they did a special 3-month year and then a 12-month year, which, to be honest with you, I've never seen before. So we probably could have kind of found a way to shoehorn it into our valuation model, but what's the point? Like, it's still early in the semester, and it would have been a lot of effort. So I switched the assignment to Costco to make it a little bit easier, but that's why we were going to have problems with VF. They switched their fiscal year. But in any event, it would have just affected the historical numbers. It wouldn't have affected the future valuation. But regardless, I did switch the assignment. So your Costco assignment is the assignments you'll be working on for the individual one. Okay. So today, what I want to cover is one additional topic that is going to be on the midterm, which is the fourth part of the valuation. We're going to start it, which is multiples. So I put up a lecture note. It's called Lecture 6. It's in the Files section. And in the Files folder, there is a file called Multiples. What's it called? Multiples Analysis. Okay. And you'll want to grab that one too in Excel. Okay, cover what we'll do. And by the way, what we talk about today will be a third question on Wednesday's midterm. So just heads up on that. So while you're doing that, just talk about multiples in general. Multiples, also known as comparables or comparables, are just an alternative form of cash flow valuation. It's a shortcut. Okay. So just as ROIC is a proxy for free cash flow, multiples are just a proxy for free cash flow valuation. Matter of fact, if you ever buy or sell a house, you're going to run into multiples in the real world. Okay, so the idea is this: you're going to have to get the house appraised, and the way the appraiser is going to do it is what they're going to do is they're going to look at similar homes at how much they've sold for recently. They'll take the price of those homes and they'll divide by the square foot of those homes to get a price per square foot. Okay, and that's where the base appraisal will start. Matter of fact, if you sign up for a service like a Zillow or something like that, they'll show you the price per square foot in neighborhoods that you're actually looking at. And you can start to see price per square foot by neighborhood. You can start to see price per square foot by city. You can see price per square foot by whatever. Okay? So the point of the story is, if you know the price, you know the square foot, you kind of know what the price is going to be. But even so, there's nuances across houses. Because if I take two houses in the same neighborhood and they have a similar price per square foot, there could still be differences. So for example, could have a different lot size, right? One could actually be older than another. One could be brick, the other could be wood. One could have a basement, one may not. One might have a master on the main, one might be multi-story. So the problem with the price per square foot is it's very simplistic. And there are some differences that could cause some nuances to fluctuate in the price to square foot. Same is true when we apply multiples to companies, right? Is that it's not as simple as that, hey, this company trades at this price to earnings multiple, therefore its competitors should trade to that price to earnings multiple. There should be some nuances between those price to earnings multiples, which we're going to get a better understanding of. It is simplistic to say everybody will trade at the same multiple. So we have to understand what drives these multiples and comparables. But the advantage to the multiple analysis is going back to it's a shortcut. So it's just an alternative way of valuation. It's also going to be something that we'll use to triangulate, because the most important thing to understand is there's only one value for a company. Okay? Just because we change our approach doesn't mean we should get a different price. Right? So if we have one price by enterprise DCF, we need to get the same price if we do a multiples. You can't get a different price if you do a different analysis. And what you're going to quickly also find is that the multiple analysis is just rearranged math. And that's really all it is. Okay? So where multiples are helpful, though, is it is more helpful to have similar companies. And so one of the things you're going to have to do this semester is find peers of the companies. So again, using my bad metaphor in real estate, looking at houses in San Francisco, which start at $1 million for starter, boxes, is different than looking for houses in Reston, Virginia. Okay, because it's a completely different real estate market, right? Just as the oil and gas industry would be different than the defense and aerospace industry in the real world. Okay, because some industries are going to have a different spread. Some industries are going to have different growth rates. So they're not going to all have the same multiples, and there will be differences amongst industries, right? Within the industry, hopefully you don't see as much variation, but you still could, because there could be some differences amongst the companies. But nonetheless, when we do multiples, as I said, it wouldn't make sense to value houses in Reston and throw in a few San Francisco houses and one in Mountain View, because that's not as comparable. So we do want to find companies that are somewhat similar to the companies that we're actually doing multiples on. That's actually harder than it sounds. We also want to use forward multiples because we're thinking about future value. Company's worth the sum of its future value, so we care more about the future earnings. Therefore, forward multiples rather than historical multiples are better explainers of that future value. Okay. Unfortunately, we do have some challenges, which we talked about, and we'll talk more about the process for doing it in just a minute, but we are going to need to use real-world data to do this. Okay. So, in the interest of time, just what I want to cover today. Back in the first week of class, we talked about, as an intro, this example from Lecture Note 1, where we talked about and introduced the concept of the key value driver equation and ROIC. And I'd actually used this slide to show you how two companies that had similar earnings and different ROICs could have different levels of cash flow. And that's how we illustrated that ROIC is just a proxy for free cash flow. Okay? And when we did this in the first week of class, we then said, okay, when you value a company, we use the rearranged perpetuity, which is the key value driver equation, and we did a simple example, and then you did a homework assignment on the key value driver equation, where we went through 4 scenarios, right? We talked about what happens when you have growth at a zero spread, what happens when you have growth at a positive spread, what happens when you have growth at a negative spread, and what happens when you have spread and the growth slows. That was one of your previous homework assignments, okay? And it revolved around this spreadsheet, which we had talked about in the first week of class. And I made a comment back then, which was probably less meaningful to you, but will be more meaningful to you today, where I said, okay, if we took these companies, which had, in this simple example, they had the same earnings, 100 million, growing at 5% a year. 10% was the ROIC of one, 20 was the ROIC of the other. Both had 10% WACs. And we said which one was going to be more valuable. And it was the same. It was the company that had, for the same growth, the higher ROIC would be more value. And we said if we took the value, the price, divided by the earnings, we got the PE. Okay? And this is the beginning of talking about how multiples are just a shortcut for cash flow valuation, just the rearranged math. Okay? And then we talked about what actually drives multiples, right? And we also said that it's not sizing. So if you make more money, you make more value, but it doesn't change your multiple. So how much money you make does not affect your multiple, okay? But nonetheless, if you generate more cash, that is one way to become more valuable. You're just bigger, okay? Doesn't make you better. So what actually drives the multiples is the key value drivers, which are these 3 things, growth and spread. So what I really need you to start to understand is that multiples are just a growth spread combination. That's all they are. Growth, return, risk. Okay? So let's just do some math to illustrate this point. So again, this is the key value driver equation. This was the math we did at the beginning of the semester and on your homework assignment for the key value driver equation. Excuse me. Thank you. So what I want to do is go back to the lecture note for today, and I want to go to this slide. So on this slide, what I did is I took the key value driver equation, started with 100 at no plat, started with a 10% WAC, similar to that other example, and I just plugged in different ROICs and different growth rates into these formulas and got these results plotted out in the table. Okay, so just 100 no plat, 10% cost of capital, different ROICs, different WACs, these would be the results. Okay, now when I did this slide originally, which came out of the book, corporate tax rate was 35%. So where's the 35% not 21% tax rate? It's become relevant in a minute. But basically, you get these values. All right, so here's the thing. Why is this value in this column stayed a billion? Yeah.
Because the capital is equal to ROC.
Yeah, because they have the WACC and the ROC are equal. They have a zero spread. So it doesn't matter what the growth is. The value doesn't change. So what does it mean to be on the right-hand side? What's happening over here? Yeah. Yeah, because why are they creating value zero?
Because you don't have a spread of zero, you have positive spread.
And what happens over here?
You're just drawing values in.
All right, everybody makes it pretty clear? Just kind of playing out the key value driver equation. This is why you're creating value on this side, positive spread. This is why you're destroying value, how much, and we can actually play on the math out. Make sense? Okay, so here's what I want to do. I want to take these results, which are the values. So if we ran it through the equation, so it would be these numbers. And I want to divide by, this is the value, divided by EBIT. So in the next slide, what we're going to do is we're going to say, okay, if no plat is 100, and at the time the tax rate was 35%, we could back out that the EBIT had to be 154. Pre-tax operating profit. Okay, so if I take that value divided by 154, I get those multiples. So said another way, a zero spread at this cost of capital is trading at a 6.5 multiple. Okay, so company X, make it up, is trading at a multiple of 6. What can we say about them? Think of this as a midterm exam potential question. Company is trading at 6 times earnings. Looking at this table, what could we infer? Yeah.
It's destroying value.
Why?
It's a negative growth because it's multiple 6 is less than 3.
Yeah, so where on this table is he seeing a 6? Well, here's a 6. Matter of fact, if we plot it, there's probably be a 6 somewhere in here. And so there's probably a curve of 6s. I can't tell you exactly what the growth and spread is, which is actually an important part of the answer. All right? So if I'm working backwards, if multiples are a growth and spread, and I know the multiple and I work backwards, it could be a range of growth and spreads that explain that multiple. But what I do know is that the spread has to be negative, because to get the multiple of 6, I have to be on the left-hand side of the table. So I may not know exactly what the growth rate is, but I know that growth spread combination is negative, so I know it's in somewhere that growth and spread range. That's what he was basically pointing out. Versus company Z has a positive multiple, they have a multiple of 7. So what could I say versus the company of 7 versus the company at 6?
Company at 7 is creating value.
So again, where are my 7s? Here's a 7, here's a 7, probably there's a 7. Somewhere along this line is their growth spread. But as he said, the 7 times multiple company likely has a positive spread in this industry, given the data that I see on this table. So the real difference between the company trading at 6 times EBIT and the company trading at 7 times EBIT is one would be perceived to have a negative spread and the other would be perceived to have a positive spread, given the ranges of growth. Does everybody see how we can draw those conclusions? Because these are the conclusions you're going to have to be able to draw. We'll make sure you can actually connect these dots. All right, that is why, by the way, in the real world, a lot of people are very naive about their multiple analysis. Because what a lot of people in the real world would say is company Z is trading at 7 times multiples. They're in the same industry as company X, which is trading at 6 times multiples. Buy company X because they're cheap. Is company X cheap? Why are they not cheap? Why is that a flawed statement? Which, by the way, people make all the time. Buy this company because their peers trading at a higher multiple. You can get them at a discount. They're cheap. And you're going to make money because they're trading. You can get them for less. They're on sale. What's the flaw? Why are they cheap? Yeah.
Unless there's a price dead negative spread.
That's right. So if they don't change their spread, they're not going to trade at the higher multiple. See, that's the missing part of people's analysis. They just assume, and what you were taught in your core finance class, is everybody trades at the same multiple over time. It's kind of a regression to the mean. But basically, that assumes that there's no competitive advantage, no differentiation amongst firms. And if firms don't have the same growth and spread, firms won't trade at the same multiple. Okay? And this will apply to valuing private companies. Say I'm valuing a private company. What are you worth in the publicly traded market? Or I'm trying to take somebody public. Well, look at a bunch of public companies and say you should trade for about this. But here's the thing. If you don't have the same growth and spread as those public companies, you can't trade at the same multiple as public companies. Right? You're going to trade at a different multiple based on what that growth spread combination will tell me. Now, I have some similarity to cost of capital in the industry, but nonetheless, to trade the same multiple requires the same growth and spread. And I'll tell you how naive you're going to see this. Turn on CNBC today, and you'll see an idiot who makes a lot of money on Wall Street. You don't have to be that smart to work on Wall Street. Just parrot what everybody else says, right? But basically, here's what you'll see in the real world. Go to Bloomberg. And I want you to start to understand this. So let's look up a company called Apple, who just reported terrific earnings. And then I want you to go to EEO. And what I want you to look at, let's talk PE, simplified PE. This is the price to earnings multiple off the EEO screen for the current one and for the future years. We care about second forward year. So in our world, second forward year, last year, forward year one, forward year two, is the first clean forecasted year. Because fiscal year one is a combination of actual results and forecast results. So forward year two is the first clean all forecast year. That's the one we tend to normalize on. So we can count. 1, 2, that's 2021 for Apple. Okay. So right now, Apple's PE in that year is 17.46. That's what they're trading on based on current earnings today. Okay. Now, I want to go to Google. And for the same period, Google, second forward year, 1, 2, for them is fiscal 2020. Their PE in the same year is 23.74. So that's what I'm saying. Buy Apple because they're cheap. See, Google's trading at 24 times earnings. Apple and Google are both great companies. You should get Apple at a discount. They're a bargain. Buy them at low PE and you'll see their stock price go up. And I'll tell you that's naive. Because multiples are a growth spread combination. Because we know on this table, the growth and return to get a higher multiple has to be different as you move across the table. So let's play this out. On this tab, I want you to switch to the growth tab. Now this is just turning dollars into percentages. Okay. Now again, these are all forecasts. And this is, I'm on Google. But what I want you to understand is right now, in the real world, row 13 is revenue growth rate. Now, growth is growth in cash flow, specifically growth in cash flow to perpetuity. But at the same level of productivity, the same margin, growth in cash flow could be proxy for growth in sales. All right? So if we maintain our margins and maintain our productivity, then we can say growth in cash flow, growth in sales are a proxy one for one. And that's what people often do in the real world. That's how they'll use growth in sales as a proxy for growth in cash flow. Ideally, you want to use growth in cash flow, but like I said, if we want to use sales growth as a proxy, here's how we'll proxy it. I want you to look at row 13, and I want you to look at Google's growth rates for the next 4 years. So last year, or this year, 20%, then 18, then 17, then 18. Okay? And then I want to come back to Apple. And by the way, that's a PE 24 in 2020. For Apple, their growth rate is 5, 8, 5, negative 2. PE 17.45. What I'm telling you is in the real world, Apple will not trade at Google's PE because they don't have that growth rate. Apple's growth rate, mid-single digits. Google's growth rate, very high teens. A company in the very high teens is going to have a different multiple than a company in the single digits. So what I'm saying is, if I said buy Apple because they're cheap, That's a misnomer. That's actually a mistaken comment. They're not cheap. They're just priced differently because they're a more mature company than Google, which is still in its growth stage. Matter of fact, what makes a company more mature is law of large numbers. When Apple gets to be this size, their revenue is $270 billion this year, going to almost $300 billion next year. It's hard to grow 20% when you're that size. That was something the book also talked about, law of large number effect. As you get bigger, the percentages get harder because the dollars are so large for these big companies, which means what should happen to the multiples over time? If we go back to our key value driver equation, and I had a company that had a 7% G and a positive spread of 10%, which is about Google, by the way, this 10% spread. Watch what happens when growth slows. This is close to Google's PE, by the way. 7 becomes 6, becomes 5, becomes 4, becomes 3. As G gets smaller, as the growth slows, the multiples compress. This was one of your homework assignments. So, if I look at the real world, as Apple's PE goes from 19 to 17 to 16, that shouldn't be a surprise. And it has nothing to do with Apple. It just says as they get bigger and bigger and bigger, and as their growth rate slows, then naturally we're not going to value a company with the lower growth rate at the same multiple. The multiple needs to compress. That's just math. So Apple isn't comparable with Google. Matter of fact, what's more likely to happen is Google's multiple is going to look like Apple's over time as Google matures. So when Google's growth rate goes from double digits to single digits, it's more likely that Google's PE is going to be closer to 17 than Apple's PE is going to go to 26. That's what's more likely. And by the way, inevitable. Because Google's not going to grow at 20% forever. Nobody can. So that's what I would actually need to understand is more likely to happen. But that's why I also go back to, you can't say one's expensive and one's cheap because they really are different based on their key value drivers. And that's the more important insight for us to have. So if a company goes public, another company, then we don't say, well, gee, you should trade at Apple and Google's valuation divided by 2, because in order to do that, you'd have to have the midpoint growth and spread between the two. Okay, so what I really have to figure out is what's your growth and spread. That's the one you'll trade closer to. Okay, and I can make some other adjustments, but I'm saying that's a more useful methodology. Okay, by the way, this is also one of the most common mistakes I think people make in valuation, because here's how you can simplify using multiples to value a company. And again, I'll leave Apple on this screen. So let's say I believe Apple is going to grow their earnings per share $1 next year. If they grow their earnings per share by $1, how much should their share price change? If Apple grows their 2020 EPS by $1, how much should their share price change? How much should it go up? This is an easy question. I'll give you a hint. Earnings per share times PE equals share price. I just gave you the EPS. What PE would you use? What PE would you use? How much did their share price go up by? Dollar times what PE? Yeah. 19.76. So basically their share price should go up $19.76. Right? Now, Apple's earnings per share goes up another dollar in 2021. How much more will it go up the second year? Yeah.
$17.45.
There's the mistake. it's more likely to go up 17.45. But do you know what people do in the real world? Correct. Actually, what a lot of people do is they'll base on the current PE. I can't tell you how many financial professionals that'll say, my current PE based on trailing 12 months earnings is 19.73. Therefore, earnings in the future times 19.73 equals my price. And they'll price themselves out for the next couple of years. But what they're missing is that as the company grows and the G starts to slow down, the multiple equation suggests that their multiple shouldn't stay at 19.7, it should fall to 17.5. And what I'll do is I'll overshoot Apple's stock price. It's no different than when people use the traditional perpetuity, which doesn't allow them to forecast a different ROIC in the future, and it causes people to overshoot. This is the simplified way the world works. So they'll take current PE, and they'll take future earnings, and they'll put them together, and that's how they'll price. I'm not saying that conceptually, it's just a simple way of doing it. It's a shortcut. But what I'm also telling you is that that will lead to some pricing errors, because what we should start to understand is as companies mature, their G's slow. As their G's slow, which is a constant interaction, multiples will contract. And it's not an indictment against the company. It's just the facts of law of large numbers. That works against you regardless, because even if you're growing at 20% a year, when you compound that, it gets harder to grow 20% a year. So if you grow 20% in dollars a year and just hold the dollars constant, the 20% is not the CAGR. The CAGR keeps going down. Well, the same has to be true for the multiple. If the G tends to go down over time, the multiple needs to compress. And a lot of people miss this nuance in the real world. So two nuances are often missed. And this is the more advanced thing that you're getting in this class that you didn't get in other finance classes, right? Which is number one, people assume everybody trades the same multiple over time. And that's just naive. They don't. Because the growth spread combinations, the cash flow combinations are different. And number two, people assume that the multiples stay fairly constant. They don't. They compress. All multiples will compress over time. Okay? So, essentially, assuming you're becoming a mature company. And so those are two important insights that you need to start to understand as we go through this process. Questions? Let's go back to our content. So we're going to get more into this after the midterm. But I wanted to at least talk about this today, which is return on equity, price to earnings multiples. So this was the key value driver equation that we talked about first week of class. We used all semester long. We use this for our continuing value in our valuation models. We use it to estimate value in multiples. But this is based on NOPLAT and ROIC and WACC, right? But if I want to do a actual price to earnings multiple in the real world, price to earnings is based on earnings per share, which is net income. Net income is not NOPLAT, okay? NOPLAT is the cash to the debt and the equity holder. Net income is the cash just to the shareholder, okay? Drives an ROIC, which is the return to the debt and equity holders. Net income drives an ROE, which is just the income to the equity holder. So I look at the equity contribution for the equity income, as opposed to the cash flow to the debt and equity holders. So NOPLAT ROIC, net income ROE. And finally, when I discount this, I discount a WACC, which is the discount rate to the debt and equity holders, versus I discount equity, which is just a cost of equity, to just the equity cash holders. So what I can actually do is take the key value driver equation, but rather than using what we did, plug net income for NOPLAT, plug ROE for ROIC, expected, plug growth in cash flow becomes growth in net income, and instead of discounting it a WACC, I discounted a cost of equity. That's the actual formula for price to earnings. And I'm doing an equity cash flow. So we can use this to calculate an equity cash flow. And by calculating this, we can understand the differences at why PEs are different. Okay? So let me give you a preview of an upcoming homework assignment and a possible midterm 2 exam question. Hint, hint. Okay, so this is the second spreadsheet that's in the multiples section. It's got 3 companies on it: Raytheon, General Dynamics, and NOC is Northrop Grumman. And it has the key value driver equation based on those 4 factors. So net income instead of NOPLAT. And by the way, we want expected net income. Okay. We have growth, but instead of growth in cash flow, it's growth in net income. And then ROE is replaced ROIC, and the discount rate will be cost of equity instead of WACC. If we know those 4 things, we will get something called the market capitalization, or basically the value of the shares outstanding, as opposed to the enterprise value, which is the value of the whole company, which was the other equation, right? And if we divide market cap by net income, we get the price to earnings multiple. Okay? So here's the thing. This equation gets us the real world PE. So just as we've done and started to do the valuation model, we know the real world PE. Let's work backwards. See, the art of what I'm teaching you how to do in this class, right, which is a little bit more advanced than what most people do, is I could teach you, here's the equation, solve for the multiple, done. Okay? But what I'm trying to get you to do, just as you do an as-is valuation of the company, I want you to be able to see, go back to the spreadsheet, I want you to be able to see a multiple and figure out the range of growth spreads that explain that multiple. Right? So rather than just saying, here's the equation, give me a multiple, I want you to look at multiples and understand why the growth spreads can be different across companies and what the market is saying about those companies given those different multiples. Okay? So let's be very specific in this industry. Data. Bloomberg is going to help us do this. So let's go Raytheon today. So we'll start out with cost of equity. Okay, just one screen. So what we're going to do is in Bloomberg, we're going to go to RTN, US equity, and then we're going to type in WACC, WACC. And on the WACC screen, what we previously used was 7.8. That was the cost of capital for the company. But what we're going to use to do a pure PE multiple is the cost of the equity, which today is 8.4%. Okay? So weighted average cost of debt and equity is the 7.8, but if I just want a clean cost of equity, it's 8.4. So 8.4. Now, EEO. A lot of data on the screen. Second forward year. Count 1, 2. Estimate. First one, adjusted net income. $3,611,000,000. Okay? So we're going to use adjusted net income for our income because Bloomberg doesn't adjusted PE. So again, what analysts are doing with the adjusted net income is they're normalizing for one-time items. So if a company has one-time items, they can exclude them from adjusted earnings. Okay, so it allows them to make some adjusted earnings as opposed to the GAAP net income. Okay, so this is the one that they tend to normalize on because they'll have an adjusted PE. So back to this. So right now, 3611. Also, right under this, second forward year PE. Right now, adjusted PE, second forward year, 1, 2, 16.85. So here, the observed PE in the real world is 16.85 right now. Also on this screen, if we either scroll down or minimize, the analysts forecast return on equity. So they don't directly forecast ROIC, but they do forecast return on equity. And this is the next 3 years for Raytheon. So 27, 27, 21. Okay, so I'm just going to simplify. I need something representative, but I'm just going to divide by 3. So equals 0.27, plus 0.27 plus 0.21 divided by 3, about 25%. Again, I'm doing the 3-year average to represent the future, but what I really need, because this is a perpetuity, is the ROE into the future. Right? I'm going to say that the 3-year average to me seems representative, but that will not always be the case. Let's say it's about 25. Well, guess what? At a 25% ROE and an 8.4% cost of equity, that's an 11.9 PE. And they're trading at 16.85. So, just as we started to do in the valuation model, what's the growth in net income have to be to explain the observed PE in the world today? What if it were 2% per year? I want these to match up. Nope, it's got to be higher than 2. 3, getting closer. 4, too high, overshoot. 3.2, getting closer. 3.25, pretty darn close. So this is the growth spread combination, approximately, that the market's using for Raytheon. A little over 3% growth, about 25% ROE at today's 8.4% cost of equity. Let's see what the market's saying about General Dynamics, another defense company. So let's go to General Dynamics. I'm going to switch out the data, GD, US equity. And then we're going to go to their WACC screen. And I'm going to get their cost of equity, which today, 7.7% WACC, 9.4% cost of equity. So cost of equity, 9.4. I'm going to go to their earnings estimates. Let's get their data. For 2020, second forward year, adjusted income, 37.25. ROE, 27, 26, 24. Six plus 0.24, about 26%, a little bit higher. By the way, their observed PE, 13.85, which suggests a growth rate of 2, 3, close. Somewhere around there. Let's do Northrop Grumman. Same thing. An OC. Let's see what their cost of equity is. Cost of equity 7.6 today. Now, if I go back here, net income adjusted for second forward years, 38.38. Expected ROEs, look at the PE here, second forward years, 15.05 right now. And the ROEs are 38, 37, 38. 38 plus 37 plus 38. So 3%? Nope. Can't be 3. 2. 1.5. 1, 2, 1, 1, 5 maybe, with that. By the way, this market cap should be the value of the equity. Okay, that's the price per share times the number of shares, 58,057,687. If we go to the DES from Northrop Grumman, their market cap at a $345 share price is 58 billion. 58. 58. It shouldn't be that different. Because if we're using, I'm rounding here, but if we're basically using same values as the market, we should get the same price using the same formulas. That's what we showed in the enterprise DCF. Multiples are just a shortcut. So what does $58 billion market cap mean? It means it's trading at 15 times earnings. Why are they trading at 15 times earnings? Because of that growth spread combination. Questions about the math or anything I've done so far? Yes.
What's the equation for the observed PE?
For which equation?
For the observed PE.
The observed PE is not an equation. It's literally their PE in the marketplace today. So just like in the valuation model, and this is a hint of why I went forward to go backwards. The valuation model said we're going to get the enterprise value to EBIT, we're going to solve for it. What we're doing is we're getting the real world PE right now, and we're solving for it. Because we have a pretty good guess of what the ROE estimates are for these defense aerospace companies. Right? We know what their net income is expected to be. Right? We know the cost of equity, so this is what the growth has to be to make the math work, approximately. Okay? And the ROE might be a little different, the growth might be a little different, but it's in the ballpark. This is what the analysts have to be using, and the institutions have to be using to price these companies based on what they're doing today. It's kind of like the as-is multiple analysis, which is the same thing. Okay? So if I were to put this on the midterm exam, and I were to ask a question, it might be something like this. Given the data on the screen, why is Northrop Grumman trading at a discount, meaning lower multiple, to Raytheon? Why is this PE less than that PE? Why is Northrop Grumman trading at a discount to Raytheon? How might you answer that question? If this were an exam question on Wednesday. One of the 6 that might be on there. Yes?
Because it needs a lower expected growth in net income to justify the PE that the market is giving.
Okay, and you'd get 0 credit on the exam for that statement.
I didn't use numbers.
Okay, so why don't you say it again?
Its expected growth in net income of 1.15% is lower than their competitors, GD and Raytheon.
Well, I'm just right now just comparing NOC to Raytheon.
Okay, it's lower than Raytheon's expected growth in net income of 3.25%.
Yeah.
To justify.
Even though, I'm going to add to your statement,
Okay.
lower growth, even though it also has a,
Even though
NOC has a,
lower observed PE.
no, higher spread. So here's the thing. You'd expect if I have a higher spread, I should be more valuable, all things being equal. I have a higher spread at Northrop Grumman than Raytheon, but I don't. Why? Because I'm not growing that spread nearly as fast. So my problem at Northrop Grumman is I just don't have the growth that Raytheon does, even though I have a higher spread. That's why I'm trading at a discount. So by the way, if I'm the analysts on the conference call, every single one of my questions to Northrop Grumman, did you win any contracts? What are you bidding for? How big is this new contract you're going to win? How fast can you get more sales? Growth, growth, growth. So you already know you got a spread. Now you got to go feed that beast. And by the way, look what happens when they feed the beast and growth goes to 3. That's a 33% increase in their share price. That's more important at this point than getting a 50% spread. High spread with no growth is not as much value. So Northrop Grumman is the lack of growth story. That's why you're trading at a discount. You're making a lot of money. I just don't see you growing as fast as your competitor. Therefore, discount. That's the insight I want you to have. You got a hand up?
Yeah. How come
This is perpetuity. In the screen on Bloomberg, we're just looking at the next couple of years. This is perpetuity. The problem is perpetuity, and again, here's the nice thing about these companies. I don't know anything about these companies right now. I could be clueless. I don't know what NOC stands for. Actually, I do, but I'm saying if you were in your shoes. But here's what I know. Going into my valuation, I would already be looking for why my company, if I were valuing Northrop Grumman, is not growing as fast as their peers. Something about their business says they're not going to grow as fast long term. That's the way Wall Street's valuing them today. That's something I would already know by doing this multiple analysis. This is why, even though multiples are the fourth section of the valuation, synergy, all these sections are synergistic. You do the multiples to help you do your EIC, right? It's just like you do the as-is. The as-is multiples tell you that Northrop Grumman is growth challenged compared to his peers. I don't know why they're growth challenged. That's the market's view. So when I'm starting to look for information, that's information I'm going to be looking for. What's the market see that's going to be the growth challenge for Northrop Grumman going forward? And by the way, this could be earnings growth, not sales growth, if they think that their margins are about to collapse. Because remember, I assumed that sales growth at the same margin and the same productivity is growth in the equity cash flow, right? But if it's actually sales growth at much lower margin, that's also less growth in earnings. So it could be a forecast of a collapse in margins. I don't know, but I just know there's less growth here, and that's why they're trading at a discount. And if I don't, and this is why I go back to the naive statement, I can't just say, buy Northrop Grumman because they're cheap. Because the only way they're going to get a higher multiple is really they got to expand that growth rate. If they don't expand the growth rate, they're going to stay cheap relative to their peers. And that's why using the word cheap is dangerous, right? Because cheap really means that you do this math and something doesn't make any sense. Because if Northrop Grumman had a 4% G and then had a PE of 15, and something screwed up, right? Then you're Under Armour and people are worried that you've been cooking the books, right? Everybody see that? It's bad for Maryland, by the way, too. Bad for Kevin Plank. I hope he's not involved. But nonetheless, back to this. But that's the problem, is that's when you see the broken company, because then the math doesn't add up, right? But right now, if the math is adding up, then they're at a discount because the market doesn't believe they're going to grow as fast. That's what they're actually saying in the PE. So it's not whether they're right or wrong, it's just that's the expectation today. So question number 2, why is Raytheon trading at a premium, means higher multiple, to General Dynamics? Why am I paying almost 17 times earnings for Raytheon and 14 times earnings for General Dynamics? Why am I paying a premium for Raytheon? Yep.
Because, well, they have the same spread of 16.6%. Raytheon's expected growth in net income 3.23%, bigger than General Dynamics.
All right, so he says it's because of the growth rate. If I made this 3.25, if he was right, these two numbers should be about the same. So that's not the reason. The 0.25% growth is not the reason, at least the primary reason, why General Dynamics is trading at a discount to Raytheon and why Raytheon's trading at a premium. I'm not saying it's a contributing factor, but it's not the primary reason. Yeah.
It's because Raytheon is growing, even though they're only growing 0.2% per year, they have a larger market cap. So
The market cap is the result. It doesn't affect the spread whatsoever. It doesn't affect the multiple. The multiple is growth, ROE, cost of equity. Doesn't affect the market cap. Yes. That won't. Sorry. Yes.
Because their cost of equity is a percentage point lower at 8.4%,
Correct.
9.4. It's, I would assume, easier for them to bring their ROE than it would be to drop their.
So you guys are finance professionals. You understand the concept of discounting, which is what he basically just said. If I discount a cash flow at 8.4% and I discount a cash flow at 9.4%, the cash flow I'm discounting at 9.4% is worth less. So even though General Dynamics and Raytheon have similar growth rates, have similar spreads, the extra discounting at General Dynamics lowers that multiple. Watch what happens if this were 8.4. Now, their multiples are much closer together. And then the explanation would be that 0.25% growth. But the primary reason is not the 0.25% growth. The primary reason is the higher cost of capital. So that's the other trick, which is, yes, it's growth and spread, but at the end of the day, we're still discounting the cash flow. So if you have the same spread, but your competitor has a lower discount rate, they're going to trade at a higher multiple. That's what's happening to Raytheon. So back to the analysts. So if I'm trying to understand what's going on at General Dynamics, General Dynamics is asking me, why am I trading at a discount to Raytheon? We have similar growth rates. We have similar returns. We have everything is very same about our business. You're riskier. You're more uncertain. That's why I put more uncertainty to your earnings than I do Raytheon's earnings, which are more predictable, and therefore I'm discounting those earnings at a higher rate. And I'll be even more specific. Bloomberg uses CAPM for cost of equity. There's three parts to CAPM. Risk-free. Is the risk-free rate going to be different between Raytheon and Northrop Grumman and General Dynamics? No. Is the market risk premium for their industry going to be different? Probably not the RM minus RF. So what's the difference? Beta. This is a beta difference. The difference between General Dynamics and Raytheon is General Dynamics has a higher beta than Raytheon. And that's not something easily changeable overnight. And so that's the point. That's why you're trading at a discount. You have a higher beta. Translation, you're more uncertain. You're more volatile. Right? So I don't know, again, if I don't know anything about those companies, I don't know the answer to that, but I do know there's going to be more volatility of earnings in General Dynamics than there is in Raytheon. So again, as I go through my EIC, as I go through my valuation, important insight to have. That's why General Dynamics is trading at a discount. And if it's Raytheon, Raytheon's the fastest growing company in the industry. That's what the market believes. If these three companies represent the industry, why? Why are they growing faster than everybody else? I should be looking for an answer to that question. So this is where I go back to synergistic to help you with your valuation. But just by doing this one simple analysis, and this is just PE, starts to give us insight. Now, after the midterm, we're going to talk about not just doing PE analysis, but other multiple analysis as well, EV to sales, EV to EBIT, because there's a lot of information in the multiple analysis, right? This is just simplistically one of them, but I wanted to illustrate that point, right? Is that, when you get more advanced, you get more nuanced, multiple analysis are not just some simplified view of saying everybody's going to trade the same multiple. If you trade at a higher price, then you're expensive and eventually trade at the lower price, or the opposite is not necessarily true. But it does mean it's going to be true is if your gross spread combination changes, that's what's going to change the multiple. And just because you're in an industry doesn't mean you're going to trade the average unless you have the average growth spread. So said another way, if I were to do an average of these three, which would be 15.25. Basically, what makes you trade at 15.25 is there should be a gross spread combination that explains 15.25. So to trade average, I need that gross spread combination. If I'm trading at a premium to that, that means I have an above average gross spread combination. If I have a below average multiple, it means I have a below average gross spread combination. It's no different than this table. That's the only way you're on this side of the table versus that side of the table is the gross spread combination. All right? Now, it was more simplified in this simple academic illustration because I kept the cost of capital constant and there were just two variables that changed. In the real world, there's a third variable that's changing here, which is the cost of capital is not the same. The discount rates are changing by company. So spreads are not spreads. Right? Spreads are spreads if the cost of capital is the same. But spreads are not the same spreads if the cost of capital are different. And that is what's causing the difference between these two companies. Similar spreads, similar growth, different cost of capital. Here, bigger spread, lower cost of capital, but not enough to make up for the lower growth. In fact, I could do this. If they traded at the same cost of capital as Raytheon, it'd be even worse. They'd look more like General Dynamics. So here, the lack of growth is their problem. But if they could grow at industry average, like I said, their share price would be 30% higher. So again, these are some what-if games that we can play, but it kind of gives me insight as to what's at least going on in terms of the market's current view of the long term of each of these companies. Questions? All right, so just remember, if I ask you why a company is trading at a premium, it means why is their PE higher than the other? If I ask you why they're trading at a discount, it means they have a lower PE than the other. And when we talk about the key value drivers for the midterm, it's going to probably look a lot like this. Right? Might just be a different industry, but I'll be asking you the answers. And part of the reason could be growth, could be spread, could be discount rate, could be all the above, could be none of the above. That's what you got to figure out. Okay? But you got to answer using numbers. No numbers, no credit. Yes?
Will we calculate those numbers on the midterm? Or
For the midterm, it'd probably look a lot like this. I'll give you the chart. Now, I will tell you that right after the midterm, because we're getting near to the end of the semester, you're going to have an individual homework assignment that's going to basically start doing this with more multiples. You have to calculate it yourself. Okay? But nonetheless, because that's also for your group projects, part of what you're going to have to do for the group projects is calculate it yourselves. Right? But nonetheless, to do the analysis. But for the midterm, since I'm just introducing it, I just want you to understand the core concept here. And the most important part of the core concept is that multiples are an expression of growth and spread because it's just rearranged key value drivers, because the value of the company doesn't change just because we rearranged our equations. And so therefore, since we know what the equations are, we should know what explains those values. We did that with the as-is with the DCF. Now we're just doing the same thing with the multiples, and eventually we triangulate the two because the multiples of the DCF have to also equal each other, which is another way that we're going to add in what I'm going to call a sanity check down the road to our valuations. Because when we start doing a valuation for, pick a company, Nike, whoever, that valuation gives us a multiple. And that multiple should match up with the multiple in the real world, just like the share price should match up with the share price of the real world. And so we're going to actually look at, as we forecast our bull and a bear, what multiples does that create when we create the bull and the bear? And do those multiples look reasonable, which means are those really reasonable growth spread combinations for the bull and the bear? It's a way to test what we're doing in a different way when we start to do our long-term analysis. But that's for after the midterm. What I need you to do right now, as a review of the first half of the semester, is this is fair game for the midterm. So again, as you're studying, it's an open book, open note, open computer exam. Okay. So again, no collaboration, no looking at previous semesters, but basically you will need a computer. Again, you'll have about 90 minutes, and make sure when you answer questions, you include numbers that you're referring to. You probably won't have to calculate any of the numbers on there, but you will be responsible for analyzing what you see. And I've given you very strong hints to what 3 of the midterm questions are going to be. Right. Any other miscellaneous things? All right, well, I've recorded this on YouTube. This will be up if anybody wants to review this. Basically, midterm Wednesday, take it during class time. We'll see everybody 1 week from today for our next lecture. Okay. Again, group case 3 on Friday, homework 9, whatever the Costco homework is, by next Monday as well. Thank you.